I'd like to call the August 24th, 9 a.m. meeting of the Investment Advisory Committee to order. I'd like to welcome the IAC members, IMD staff, and guests that are on site and calling in. We'll start with our Pledge of Allegiance, if you'll stand and join, and then our salute to the North Carolina flag. Pledge allegiance to the flag of the United States of America, and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. I salute the flag of North Carolina and pledge the old North State love, loyalty, and faith. Thank you all. I'll now ask Ben Gardner to call the roll. To verify that we have a quorum. Yeah.
Good morning. This is Ben Gardner, General Counsel, Treasurer, Mr. John Anarella, Mr. Lentz Brewer.
President, good morning.
Good morning. Mr. Coakley. Mr. Mevin. Here. Good morning. Patterson. Here, sir. Morning. And Treasurer Falwell.
Here.
Right. Yes, sir. We have a quorum. And I'll go ahead and remind members, especially Mr. Brewer calling in, please remember to mute your phone when you're not speaking. Please state your name if you're making or seconding a motion. And if you need to leave the meeting, please let us know. And then when you rejoin, please identify yourself. Anything that the committee votes on, we'll do by roll call. And today's meeting agenda is posted for public availability on the Department of State Treasurer's website, www.nctreasurer.com, Investment Management Division webpage. And if we lose the phone line connection, we'll be deemed in recess until we get reconnected, at which point we'll resume the meeting. All right, Treasurer. Turn it back to you for approval of the minutes.
Thanks. Members, you have our meeting agenda. And as you've heard, if anybody has a conflict or the appearance of conflict regarding the matter before, just be sure to let us know. We'll jump right into it and ask for a motion to approve our meeting minutes. So moved. Second. Motion is second being made. Any further discussion? Hearing none, the clerk will call the roll.
Mr. Brewer?
Yes.
Mr. Brewer?
Yes, approved. Aye.
Thank you. Thank you. Mr. Mevin? Aye. Mr. Patterson?
Aye. Now we'll go and hear from one of our co-CIOs, both our co-CIOs. It's a long morning already from Winston-Salem. We had 3 meetings this morning already. So, and we'll now hear from Christopher Morris and Jeff Smith.
Morning. Good to see everyone here. Wish the quarter was as good as the morning was, I guess, today. At the end of the day, it was a real rough quarter, as we all know. The market highest inflation we've seen since the 70s, with one of the readings topping out over 9%, supporting gas prices, consumer confidence plummeting in the second quarter, largest rate hike by the Fed in 20+ years, as they committed to controlling inflation. On the equity market side, I'll let Rhonda touch on that more when she goes over her section there. I'll maybe touch a little bit more on what happened in the bond market here. Really rough period continued for the bond market. Rising inflation and aggressive Fed resulted in sharply higher interest rates again. In the second quarter, we saw rates rise anywhere from 50 to 70 basis points at different points of the curve across, and that just built on what we had already seen and how dramatic it's been. If you look back 12 months for the fiscal year, we saw rates on the short end up, 2-year was up 270 basis points, long end was up 110, and then various points kind of in between that. So again, a real dramatic period for bonds. On the spread products basis, investment grade corporates were up about 40 basis points wider, as you might expect with higher risk during the quarter, and high yield was up 250 basis points. So again, more pressure as you would expect with spreads wise on that. Real notable part, I think, in the quarter, and it's been much talked about, was really the breakdown in the traditional relationship of stocks and bonds, as both were down materially on a return basis over an extended period. And I was reading one interesting piece about kind of putting that in historical perspective, since the mid-70s, among all the observations of those two, the largest two public markets, among 12-month returns, those asset classes, that negative on both sides has only recurred in less than 0.5% of the time since the 70s. When you looked at it on a shorter period of like 6 months, 3.5%. And at the 12-month mark, that's where we are, really negative returns, and you'll see it in some of the slide deck there for both markets. So a real departure from what we've really seen historically between these, where typically you see when risks are up, you see treasuries being kind of the flight to quality trade, and that kind of being the stability part for plans, and that just hasn't been the case in this period. On the Fed front, we saw, again, aggressive actions made. We saw an increase of 50 basis points, June 75, July another 75, we met last, and then taking a little peek at what we think they're going to do going forward. Fed futures for the September meeting show roughly a chance of in between 2 and 3. I think it's like 2.6 is kind of the number on hikes. And then towards the end of the year, we have another meeting in November, and we're looking at a total based on futures of 4 hikes in there. And then maybe a 5th one by December 14th. So really a total expected, if you look at futures, of another 125 basis points by year end. If you look out a little bit, hold up to see kind of 2023, May to June next year is where futures are showing the first time we see a slight chance of futures of a rate cut. So more increases on the way as they tend to try to fight the inflation part. And so we kind of know what's coming on that part. With that, I'll turn it over to Chris.
Good morning, everybody. Nice to see some of you in person. Turning to slide 7, our assets under management slide. You can see that assets under management was at 167 billion as of June 30. So this is down about 3.8 billion for the quarter and down about 4.4 billion for the past fiscal year. The decrease, as you can imagine, was due to the depreciation of the pension plan of the NCRS portfolio, which decreased a little more than 10 billion for the fiscal year. On the flip side, we saw the cash management program continue to receive a lot of inflows. That program increased about 8 billion for the fiscal year. So that portfolio continues to hit all-time highs. Moving on to slide 8. So our asset allocation as of June 30. So the portfolio ended June just under 111 billion. It was down about 8 billion for the quarter due to the large equity drawdown mainly. This slide shows our portfolio positioning as of June 30 versus our old policy targets. If you remember from the last meeting, we went over the revised investment policy statement with the revised policy targets and ranges, and all of that went into effect as of July 1. So we showed this snapshot as of June 30, which was really the last time we were using our old policy targets. And if you flip to the next slide, slide 9, you'll see kind of a more recent snapshot. This is as of about a week ago. The markets bounced pretty significantly in July and into August, up until about the last week. With the value jumping close to 5 billion or 4 billion, probably to about 115 billion as of about a week ago. Again, this shows us versus our new policy targets. So as a reminder that the main changes that we made to our policy was to public equity. We reduced that target from 42% to 38%. We increased pension cash from 1% to 5%. And then the other minor changes we made was a 1% increase in private equity from 6 to 7, 1% decrease in multi-strat from 2 to 1. So these are reflected in these targets, as well as the new ranges that we determined and was approved and went into effect July 1. So you can see where we sit versus our new policy targets. The growth underweight is at about 6.4%, led mainly by public equity at about 3.7%. And again, the underweight's much less than it was previously, given the change to the policy target, as well as we did put about $1 billion into equity in Q2. You'll see a little bit more of that later in the slide deck, and then I'm sure it'll be discussed in the public equity presentation as well. The overweight to rates and liquidity is at 5.9%, with all of that overweight coming from the pension cash, even though that overweight is less than it was before. We're slightly underweight IG fixed income at about 1.4%. The underweight to inflation sensitive and diversifiers continues to decrease. It's currently at about 0.4%. These assets have performed very well in this environment, which is what you'd expect in this higher inflation environment. So we're happy to see those assets perform pretty well, which leads to the decrease in the underweight that we did have. And then multi-strategy is now slightly underweight by about 1%, and that's due to the change of policy that we made from 2 to 1%. Moving on to slide 10. So this is the portfolio returns versus our two main benchmarks. You can see some pretty negative returns here for the recent time periods. Portfolio was down about 6.7% for Q2 as both equity and bond markets decreased. Equities was down more than 15% for the quarter, and our IG fixed income was down close to 5% for the quarter. On a positive note, as I mentioned, the inflation sensitive and real estate portfolios continue to have strong returns for the quarter, with non-core real estate up about 4.7%. Inflation sensitive was up about 3.7%, and core real estate was up close to 1% for the quarter. So we are still seeing some strong returns in some of these asset classes, but the main drivers, which is our largest allocations, of course, was equities and IG fixed, continued to struggle. The 1-year return was negative 7.25%, again, driven mainly by the negative returns in both the equity and bond markets. And pretty much all of that downturn we saw in the first 6 months of this calendar year, right? We were down about 10% calendar year through June 30, and down, just over 7% for the fiscal year. So with this pullback this quarter, the portfolio has only exceeded the actuarial rate of return of 6.5% for the 10 and the 20-year time periods. On a positive note, looking at relative performance, it was extremely strong for the quarter, significantly outperforming both our implementation benchmark and our long-term policy benchmark. The outperformance was driven both by the positioning of the portfolio, the fact that we were underweight equities and overweight cash, as well as strong relative performance from some of the asset classes, specifically investment grade fixed income, opportunistic fixed income, and inflation sensitive. For the 1-year time period, the fund outperformed the implementation benchmark by 0.9%, which you'll see the attribution to that in a couple of slides. And it outperformed the long-term policy benchmark by over 5%, which is a pretty large outperformance. For longer time periods, still showing strong relative returns for both benchmarks across pretty much all these longer term time periods. So we continue to see strong performance versus our targets, which is nice. Taking a look at Q3, equity markets have rallied throughout July and into August before pulling back some in the recent days. Portfolio as a whole is up around 2.5% calendar year to date, but it's still down about 7.5%, up 2.5% quarter to date, sorry, and then down about 7.5% calendar year to date. Taking a look at the next slide, this is the growth of the dollar chart that we show every time. No significant changes here. We continue to see that the portfolio is outperforming both our benchmarks on the long-term basis, as you can see since inception of when we started tracking this. Slide 12 shows the same growth of a dollar for two different time periods, the 5 and the 10-year time periods, and it overlays kind of our alternatives allocation on top of that. So you can see how the alternatives allocation has helped the portfolio as a whole on both time periods. Specifically, you can see the 10-year, how strong those returns have been. So that it's been extremely additive to the portfolio over the medium and the long term. Moving on to slide 13. This is the contribution to total plan return for the 1-year time period. So this shows how each asset class contributed to the returns and to earnings for the year. So you can see on the top right, the total pension return negative 7.25% for the fiscal year. That equated to about a loss of $8.4 billion in earnings. You can see that with both IG fixed income and public equity struggling last year with pretty strong negative returns and negative contribution to return for the total plan. It was really the alternatives that had was additive to the portfolio, with private equity leading the way, which we saw last time as well, where we had extremely strong private equity returns. And we're continuing to see that. Now, it's got to take into consideration that some of these asset classes have a quarter lag, and I know Craig will talk about this a little bit later with his presentation, but we're starting to see the June quarter end numbers come in for these alternative asset classes, and with the public market struggling so much, we're likely to see some of the gains we made there come back in, and we're starting to see that when we're getting our quarterly reporting in for these assets. Moving on to the attribution charts. So slide 14, this shows our return versus our implementation benchmark for the 1 year ending June 30. As I mentioned before, the portfolio outperformed the benchmark by about 0.9% for the fiscal year, which is strong relative performance. On the top right, you can see the decomposition of that outperformance with the selection and allocation effect. As a reminder, the selection effect shows how each underlying asset classes performed relative to their individual benchmarks. And then the allocation effect shows how much excess return was driven by our portfolio weights versus our portfolio targets. So our actual weights versus our target weights. So you can see that the allocation effect really drove the outperformance for this fiscal year, specifically the underweight to public equity and the overweight to cash really was additive for this fiscal year, and really mainly for the last 6 months, with obviously the large drawdown in both the equity portfolio as well as the longer duration IG fixed income portfolio. So the cash was really additive in this 6-month time period. So you can see the allocation effect added 1.22% to that excess return. Selection effect was slightly negative, and you can see in the bottom right it was mainly due to public equity. Rhonda will talk a little bit about the performance recently. Public equity portfolio struggled the last fiscal year from a relative perspective, but longer term, there's still quite a bit of value. A little bit different story on the 3-year and the 5-year on the next 2 slides. So on the 3-year, you can see that we were basically flat versus our benchmark return, both at 4.9. And that was driven. You can see the selection effect was additive by about 0.7%, and then the allocation effect was negative by about 0.7%, offsetting the selection effect. And then on the 5-year, you can see that we did have additive on slide 16. You can see that we did outperform the benchmark by about 0.3%, and that was mainly driven by selection effect, as all asset classes on the bottom right, you can see, have added to the portfolio over the 5-year time period. So certainly what we like to see when all of our individual asset classes are outperforming their longer term benchmarks.
Yeah, I think that's really notable to see that across all asset classes for that time period. It's something I know that everybody on the team should be really proud of.
Yes, absolutely. Moving on to the next slide, slide 17. Again, this just shows several different risk metrics for the portfolio. I'll just hit on a couple. You can see in the top left the rolling volatility of the portfolio. So volatility remains high, and it spiked a bit in Q2 given the extreme volatility of the equity markets and the fixed income markets, as we've talked about. The portfolio for the 1, 3, and 5-year time periods, which we see in the different lines, the blue, the yellow, or the blue, the orange, and the gray line there. All 3 remain elevated versus its long-term moving average. So we definitely see higher volatility than we had seen in the past. Again, it's nothing like it spiked in 2020. You can see there with that blue line spiking in 2020. And we obviously had extreme volatility going back, a little more than a decade ago in the financial crisis and coming out of the financial crisis. But we had talked about before, we had a long period of very, very low volatility. And you can see that in the middle there in that chart, it kind of trended down for a long period of time before beginning to spike up in 2020. And, we've continued to see volatility, not quite like that, but, pretty significant volatility in this year especially. And then looking at the tracking error in the top right, again, we saw this spike significantly. This kind of shows the standard deviation of our excess returns. So how much we deviate from our benchmark. And that has a lot to do with how far away we are from our policy targets. So you saw that spike significantly again in 2020 with the shutdown of the economy for COVID. You saw that come in quite a bit last year before starting to spike again. So you can see the long-term trends are certainly higher than it had been in the past. But I would expect this to start to come down, mainly for the reason of, we changed our policy targets to be closer to in line with our actual weights. So if we're closer to our targets, the tracking error versus those targets will likely be lower. So I would expect that to trend down slowly over time, but I guess we'll wait and see that. Look at slide 18. Again, we show this chart every time. This kind of shows the downside capture of the portfolio and then the drawdown capture that we get with when there's drawdowns in the market. And you can see, we talk about how we're conservatively positioned and we typically do a lot better than the market when there are bear markets. And we did see the same thing in this one. You can see on the far right there, the pretty significant drawdown. The green line, there's the S&P 500. So that's basically the equity markets. And then kind of the orange line is the portfolio itself. So significantly outperformed the benchmark. This one was a little bit more challenging, as we talked about, than others in the past, given the way that the bonds reacted as well, and the fact that the flight to quality to treasuries wasn't quite there, and we had negative returns in both the bond and the equity markets. But regardless of that, we still saw that we had pretty strong returns relative to the equity markets during this time period. So still, it reacted the way we would expect. Didn't have quite the protection it normally did, but still reacted pretty much how we would expect in terms of significantly outperforming the broader market. Moving on to slide 19. So again, this is the universe comparison showing our portfolio versus our public fund universe greater than 20 billion as created by BNY Mellon, our custodian. So these aren't all of our peers, but it's everything that BNY Mellon has access to. So there's about 15 funds in this universe typically. So you can see for the 1 year period, we were right at the 75th percentile for returns. Continue to remain one of the lowest risks. You can see on the bottom, the risk chart there, one of the lowest risk among all of our peers for all the time periods. I did take a look at specifically calendar year to date through June, because that was really where we saw the large drawdown, right? To see how we perform versus our peers during that specific time period. We typically don't only show the longer time periods because that's really what we want to focus on. But I thought for this, it was pretty unique time period where the markets drew down pretty quickly. So I did take a look at the 6 month number, and we did fare much better versus our peers with that. We were in the 38th percentile for the 6 months ending June 30, where our return was roughly negative 10%. So that's more in line with what we'd expect. We typically talk about how we do better than our peers during down markets, do worse during up markets, given our more conservative risk profile. And that kind of bear down. It was a shorter time period, but it did bear out in those numbers.
So 38th percentile was for the return percentile for a 6 month ended June 30.
Correct. Yeah, so we were in the third. So we were above median. We were, in between median and top quartile for that time period. And again, it was a unique, as we talked about, pretty unique in terms of, our larger allocation to IG fixed didn't kind of cushion the portfolio as much as it normally does. But even with that, it still performed, portfolio still performed pretty well given that.
I think probably one of the differentiators you would see, given that both markets were down, like Chris said, typically you would see us rise higher in that number in this environment where stocks are off this much and risk is up. Is probably a lot of it is, we talked about the returns on price markets. So of course the exposures to privates are going to be very different across these different plans. And so what a plan's exposure was in those markets probably dictated a lot of where you were in that percentile as well.
Moving on to slide 20. Again, this is the Sharpe Ratio chart. with, Sharpe ratio is essentially a measure of risk-adjusted return, so it kind of combines both the return and the risk. Typically, on the longer-term time periods, we fare quite well on this, given our lower kind of risk profile. Shorter time periods, we can struggle, which you can see in the 1 year time period where volatility was so high throughout, which led to kind of our showing at the 94th percentile for the 1 year and 60th percentile for the 3 year. Slide 21 shows the liquidity profile. Again, this doesn't change much from quarter to quarter. It looks at each asset class and shows kind of, we categorize each type of investment in different liquidity buckets, level 1, 2, 3, and 4, depending on the amount of liquidity that it has. And by policy, we try to have at least 70% in level 1 liquidity, which is very liquid assets across the portfolio. And as of June 30, we were right at about 74% level 1 liquidity. So still significant liquidity in the portfolio, no real issues there. And like I said, it doesn't change dramatically from quarter to quarter, given where these portfolios are, and we don't move that quickly with them. Slide 22 is the liquidity profile for the net benefit payments for calendar year, and we show that versus our kind of monitoring guideline of 3%, which is that solid orange line there. We continue to have outflows of greater than $2 billion per year for the net benefit payments. And you can see as a percentage of the plan that's been going down, which is a good thing. It's been below 2% for the last several quarters, so well below kind of the monitoring threshold that we have. And then slide 23 shows our cash flows for our alternatives portfolios. You can see on the top right there that for the total alternatives, we saw a net inflow of about $5.7 billion for the prior 12 months. And then a net outflow of about $2.2 billion. So about $3.5 billion total cash inflows we saw for the fiscal year. So we continue to see more money coming in than going out, but that's pretty consistent with what we'd expect, and obviously with some of the very strong returns for the last half of this year and really into this year for some of those asset classes, we have been seeing some realized gains that came in. It may slow down. We are starting to see it slow down a little bit, at least, given where the markets have been the last 6 months, but continue to see net inflows to the portfolio.
Chris, can you go back to slide 22? That one's always a mystery to me. Now we got gray and blue.
So the blue is what we've actually paid to date. The gray is projected for the rest of the year. So for 2022, it's really only half the year, right?
Oh, that makes perfect sense.
Yeah, so we just try to show the projected so it doesn't look like we're only paying half. So we do actual paid today and then projected for the rest of the year.
But you have said in the past that our net payments were lower than what intuitively we feel they should be. With the number of retirees and their living.
Right. Yeah. I mean, it's a function of, we've looked into this. It was a function of how the plan is essentially funding, how the portfolio is getting funded, right, with the ECRIS policy that we have in place, and they're pre-funding some of it. So we're actually getting more money in. So in the short term, it actually has decreased the net outflow from the actual investment portfolio, even though benefit payments in gross continue to go up.
Correct.
But this is just what actually gets removed from the investment portfolio. And obviously, the lower that this number is, the better it is for the long term, because there's more money in the portfolio to get, earn returns, right? So,
Because our funders are the ones that are making this possible.
yes.
Our retirees are retiring earlier, living longer, but the funders are the ones that are making this possible.
Correct.
The league, the county commission, the general assembly.
Absolutely. Yep.
All right, thanks.
All right, and then the last one I'll hit on real quick is slide 24. Again, shows just how our portfolio is valued. As we've talked about before, some of the illiquid assets are really valued on a quarterly basis, really on a quarter lag. So for instance, like our private equity portfolio, all the values in our June 30 are pretty much March 31st numbers, right? So as the June 30 numbers roll in, they roll into our valuation. So you kind of have a quarter lag in terms of the actual performance. So you can see here that the vast majority of the portfolio is actually valued on a daily basis, where we have 74% valued daily, and then we have an additional 7% or so valued monthly, either with no lag or maybe a 1 month lag. And then the remaining 18% is quarterly valued. So you can see that 82% of the portfolio is valued at least monthly, and then the rest of it's really a quarterly valuation, typically on a quarter lag. I'll turn it back over to Jeff to hit the rest of the slide deck.
On slide 25, we've got the asset class net of fees performance data. Looking at the 1 year column there with the ugly stuff first, obviously the public equity we talked about on a 1 year period down 20, and then IG fixed, you can see almost down double digits on our book, and versus the benchmark was worse than that. So there's any silver lining on the IG fix is that we talked about kind of how we'd have this short duration position on. That was the right place to be relative to that benchmark. So we were positioned kind of, I think, as well as we could be with that. But we were running elevated cash within core fixed income. We had the duration shorter. We had things right on the credit side. So the net effect of that was relative to our benchmark, actually, the 200 basis points outperformance, we're over that in core, was actually the most we've outperformed since we went total return to 97. So in an ugly market, we at least were pleased we were able to protect some of the assets in that manner. So.
And what's that doing for you now as you're reinvesting at higher rates? So.
Well, we're really seeing it. Well, best way to put it in perspective, we look back a year ago, the yield on our book was about 2%. Now it's 4%. So we're basically earning twice as much now with higher rates. So it's really ugly on the short term when we're feeling that pain with rates going higher. But now we've got expected returns in one of our large asset classes at higher rates than we've seen for quite a while. So it's good news going forward from this point, at least, or a lot better position on expected returns.
So if the treasurers go to 6.5, we just sell everything, everybody goes home?
We'll see. It would be painful getting there, just like it was for this passport, that's for sure.
So what's happening with your duration now?
We're starting to working on narrowing the gap. We've been putting some money back to work inside of our core fixed income book that we had on the sidelines to try and narrow that towards it. Not going all the way there yet, but we started to kind of chip away at that to kind of narrow it back down.
The gap you're trying to narrow is what?
We were pushing at 2.5 on core. We were short duration, and we're working on trying to cut that in half in the near term. We've put, I think the
duration was 2.5 on corporate.
2.5, no, on the entire core fixed income book.
Right.
We're about 2.5 short relative to our target benchmark.
Which is?
Well, our duration was running around 7, or under 7 at one point. And we were pushing 9 on the others.
So the benchmark is 9.5.
Roughly, yeah. Blended together, we've got part core, part cash in that benchmark, yes. Mike, you had a question?
No, go ahead.
That's the gap you're trying to close.
Yes.
Wait, how is the inversion affecting your strategy right now?
The inversion, it's there. It's not, it was moderate. I think we were at 2 year was 330, 10 year was 306. It was a little flat there. I'm less excited about the extension there in that regard, but really we're wanting to take on and get on more of that interest rate risk on the portfolio at this point. So we typically, remember the way we manage that book, of course, is 5 year and out. So we don't really hold much on that 2 year part. So when we're rolling out our paper, it's kind of almost flat. On the credit rolls, we're actually doing, the credit curve is still generally positive. So we're doing a little bit of a pick on the credit extensions that we're doing there.
How are you doing on tips?
We had very little in the book. I think we still have maybe two bonds left on that part as a whole. What we've really seen in that break-even market has been interesting. So break-even being kind of the difference between nominals and tips, and really a representation of inflation expectations. So 5 year break-even now was at a low 280s currently. That number was at 3.5 in the middle of Q2. So that market's telling, is at least to me, signaling that they think the Fed's got everything in control and it's not a long-term problem.
Thank you.
Staying on this page on 25, focus on the really good parts here. If we look at private equity, non-core real estate, inflation sensitive core real estate, we talked about, showed all that data on our private market returns. You see really strong returns across those asset classes. And while Chris mentioned there can be some timing difference in valuation, when we push across and look particularly at private equity and non-core real estate across all those time periods, the returns you see there show those asset classes exceeding public equity and certainly fixed income across all time periods. So really net of all fees, really additive for us on what's been going on in those asset classes as a whole over time. Moving to slide 26, which just has our kind of a heat map here on by asset class returns. Just looking on the far right again, there's your IG and public equity at the bottom. I think one thing that you have to feel good about as far as the inflation book we see normally across the clear is not our real return seeking area for us necessarily. But when we've had inflation, you certainly want to see that your inflation to the book is doing well. And if you look at that, we see that's one of our higher returners there year to date and had 12% there in 2021 too. So getting what we would expect out of that piece of the book in this kind of environment. Moving to slide 27. You can see on the left here our new incremental investment stuff on there. So, and the first thing that jumps out obviously is that 15 billion that's on there. Chris mentioned a little bit the money that's flown in. Some of that's a combination of things that we combined some accounts. I'll let Rhonda touch on that some more in her presentation, and you'll see obviously on another slide where that data is. But your other things that are in there, you see the Blackstone 500 on non-core and another piece there in BlackRock will read as well. And on the right side is our update on unfunded commitments. As perspective, that number with a couple of new things we did on the left is a little bit higher than last time. We were just over 6 billion total last meeting, 6.7 here, and the bulk of that in that non-core piece that you see on the left with Blackstone.
Yeah, just to be clear, that 15 billion is not new money that went to equities. It was, again, we'll talk about combining a couple of accounts.
Yes.
Yeah, just want to make sure that that's clear. It's a new account we created, but it's not all new money anyways.
So slide 28 just has a graph representation of our unfunded and new commitments. See, we were at 5.06%, 6% as a percentage basis before 5.28, just reflecting that the slight increase we had that you saw on the last chart, but still well below levels we were back 6-7 years ago. We'll move past 29, nothing really new on there. Slide 30 has, we're referencing the other accounts that were combined. So these are exited. Really, those were just the top two were what was combined into the other account you saw on the other slide, plus some additional money that went in on that as well.
Because people listen on the phone and sometimes facts don't matter. Can you somebody's going to see this redemption of $11 billion? Just put a little finer point on that if you don't mind.
Yeah, so what we did was we had two internal portfolios that we managed passively. We had a large cap and a mid cap. We just combined the two to manage one kind of large cap portfolio. So Rhonda can talk about it a little bit later. I know it's in her presentation, but for a number of reasons, it just made things more efficient. We're essentially investing in the same assets. It all managed to the Russell 1000 index, but we had it broken up between a Russell top 200 and the Russell kind of mid cap portfolio. So we essentially just combined two accounts into one. But in doing so, we essentially closed out two accounts, created a new one. We basically just moved the assets from one account to another and added some incremental money, but about 500 million. Why? Mainly for operational efficiencies more than anything. I know Rhonda's going to hit on it in her presentation.
Yeah, we will touch on it, but it's more for operational and cost efficiencies. Initially, it was set up as two separate accounts to allow for us to trade, in one account versus another, but we haven't really done a lot of rebalancing over the course since we've implemented those two strategies to make a significant difference there. So we made the decision to just consolidate to the Russell 1000 and do the rebalance on an annual basis.
Yeah, it created some noise quite a bit around when we had the two around when the Russell rebalanced. We'd end up having to move assets in between accounts and to try to minimize transaction costs, and it created a lot of operational inefficiencies we realized. So by doing that, it eliminates a lot of that. But again, it's the same investment. It's just in one account as opposed to two.
It's intuitive.
Okay. Thank you.
All right, then finally on slide 31, our top 20 managers. Of course, the two internal pieces are up top there. The number was right at 54% last time, so no real material changes in here. A slight increase in the internal piece, but I think all the names remain the same except for, I believe, the 20 kind of flops around depending on which market's in there. So I think Monarch's in there now, and last time I believe it was Franklin Templeton, I believe, was the 20th.
Add, even though this is the Investment Advisory Committee, that there's a lot of chatter and buzz around the country about ESG and social investing, and a lot of spotlight on BlackRock. You see BlackRock's one of the largest managers here. We are probably in the 5th or 6th inning of, we have a fiduciary responsibility to be loyal to our members, not to Wall Street. And at the same time, BlackRock does not own these assets. Our teachers and state employees and local employees own these assets, but they vote them sometimes in a way that fits their needs, not ours. So we're probably in the 5th or 6th inning of separating, letting them manage the money for the 2 basis points that they manage this money for, literally in some cases 2 basis points, but removing those proxy voting opportunities from them so that we'll have our own process for that.
That's accurate. Yeah, I mean, for all of our managers, if we manage in a couple different ways for public assets. If we have separate accounts, which is at our custodian, BNY Mellon, we have our own proxy voting policy that we've hired Glass Lewis to help us implement. But all those assets get voted based on our policy. Anything that's in a commingled fund, which most of that stuff's through BlackRock, that's what the treasurer is referring to, where BlackRock votes those proxies on our behalf. And we are in the process of being able to remove that part of it from BlackRock and having our own policy, Glass Lewis vote based on our own policy through the commingled funds that BlackRock has. And we don't have a lot of commingled funds in the DB plan. There's a few that BlackRock manages for us. There's more on the defined contribution side because they manage basically all the passive money on the DC plan, which obviously is outside kind of the scope of this committee, but we're doing that across the board where we're going to be utilizing our own proxy policy for the vast majority of the assets that BlackRock manages.
As you take over the proxies yourself, how is that done? Are you sending people to meetings, or are you going through the
It's essentially
filings?
Like I said, we utilize Glass Lewis as a third party to help us with that. We create our own policy and we approve our own policy, which sets forth kind of how we want to vote proxies in general. And Glass Lewis takes that instruction and votes on our behalf for using our own policy. Now, if we want to pull a specific proxy and vote a specific way, we have the full ability to do that as well. But again, I mean, there's thousands of proxies every year, right? So there's no way that staff can be that intimately involved in every one of those proxies, right?
Paying them to do it.
We're paying them to vote per our policy, yes.
And so they're taking what you're doing, comparing against policy, and let you know whether or not you are within policy.
Correct. Yep, they're voting versus.
Just seems like it can be overwhelming volume of work to go through all the proxy process.
Correct. Yeah, which is why there's no way we could do that ourselves. So that's why we set a policy that we're comfortable with, that we want to be implemented. And we have the ability to change that, to customize it however we want.
But if you see something, you can go into that, that company.
I mean, if there's a specific vote that we know about that we want to specifically go in and vote a specific way, again, we generally don't do that because we just want to vote versus our own policy that we've already approved internally, right? But we have the ability to do that if we need to, or if we want to.
One more question on this. How is that fee developed? How do we know what we're paying for that service?
For Glass Lewis.
Is it a bunch?
It's a flat, we currently pay, correct me if I'm wrong, Ben, but we currently pay a flat fee for them annually.
It's less than $100,000.
Yeah.
9,000?
Less than 100.
Yeah, it's
Wow.
50, it's combined between the DC and DB plan. It's around 50,000 currently.
Not material.
Yeah, and it's combined between the DC and DB, so we split it based on activity pro rata versus how many ballots.
And I'm fascinated by this. And staff is determining the policy.
Yes, so we have corporate governance committee internally that is essentially in charge of that. So we obviously have the treasurer's input in all of that as well, in terms of just setting that and reviewing it annually and making sure that it's how we want it, right? So, and we have the ability to adjust it at any point in time.
Thank you. So I'll just add to this, that what I've tried to do is not confuse activity with accomplishment. With the internet, rumors fly, misinformation gets put out there. We spend a lot of energy reacting to stuff that just isn't true.
Right.
So I'll give you an activity with that accomplishment. And, Bruton Smith just passed away, but I think he was the controlling shareholder in Speedway Motorsports, and I think Sonic Automotive, for example. Those are two, I think, publicly traded companies. And, they came in with this big, not these folks, but, there's a big deal about the conflict of interest. But one of them, I think Speedway Motorsports was going private. And we need to step in. Well, hell, he owned 82% of the stock. I mean, it was just, he didn't care what we thought. Right. Now, engine number one, which is the Exxon proxy battle that went on a couple of years ago. Engine number one, those folks controlled like 1% of Exxon stock, but through Glass Lewis and some other, and a lot of effort, they got two folks elected to the Exxon board. And so that's a whole different thing. And so we're trying just to not hit the guardrails on this stuff, not to confuse activity with accomplishment. Try to set a social agenda with these investments, and that's where our focus is. And I think we pretty much get it right. But there's a lot of criticism about Glass Lewis and the other proxy service. I can't remember.
ISS.
There's a lot of criticism on the street about those two people working in tandem with the folks at engine number one versus Exxon. And we just try to stay out of the news about all this and remain loyal to our members. That's all we try to do.
Are there any investments that we have now that we are being more active in their internal policies? Or are we just standing back?
No, well, I'd say the only thing we react to is boycotting policies that boycott Israel, things that comply with North Carolina law that's on the books. Most of the things we deal with are not proactive, we're reacting to them.
Thank you.
Yeah, we have divestment statutes that we have to abide by where we can't hold certain companies if they have certain dealings with Iran or if they boycott Israel. I think those are the only two we have now, right? We used to have a Sudan one, but that one's been repealed. So we have to, as part of this process too, I mean, we monitor that and make sure that we're, abiding by statute essentially.
We just try to use common sense.
Good.
Is that it?
Any other questions?
Any questions from the phone? Is anybody on the phone? Oh, I'm sorry.
Mr. Coakley and Mr. Brewer.
Hey, folks, this is Treasurer. Just wanted to see if you had any questions for Jeff and Christopher before they hand it off to public equity.
Let's Brewer, I'm good.
Thank you.
I just have an observation. We talk about the roughly 90 basis points that exceed the short-term benchmark, but I think it's good to put that in perspective. That means there's an extra $1 billion in the portfolio because you did that. That is significant.
If facts matter.
Yeah. Yeah.
So, all right, next. Greg, what's going on with you? Get that pre-approved?
Yeah.
You just trying to avoid the dress code, I think.
Good morning, everyone. For the benefit of the board members on the phone, it's Craig Demko and Brian Bolkar. We're going to go over the private equity portfolio, but I'm being called out. I'm sitting here with a temporary cast on my arm. The front page of the newspaper to sell the newspaper is I was hiking down a mountain and I got attacked by a bunch of wolves, and one of them got my arm and damaged it really good.
Big news.
But the truth is, I was walking down my stairs, the garage door was opening, and my dogs got excited and took my legs out from underneath me, and I did a header down a flight of stairs and snapped my wrist pretty good. So anyway, it's private equity.
Sorry that happened.
Thanks. So just begin here with the normal that we review all the time. Our statutory allocation as of June, recall that our legislative cap is a combination of private equity and multi-strat, and that's capped at 8.75%. As of June, we were at 8.38%, slightly below the cap, with private equity being 6.4%. Now that is above our policy target as of June 30th, but as Chris highlighted, we changed our target. So we increased it by 1% to 7. So we are below our internal policy target. And again, that was a result of the asset liability study. Slide. Private equity composition. Basically, the chart on the top left shows you the underlying strategies, buyouts, special situations, and growth venture. Rough numbers, we're at 40% buyout, 30 for growth venture, and 30 for special sits. All are within our June 30th policy ranges that can be seen on the bottom right. Venture capital and growth equity is close to the upper end of those ranges, and buyout is closer to the lower. However, we do expect the venture capital growth equity piece of the pie to come down. One, based on valuations coming in some. As Chris highlighted, our June valuations are really marked as of March cash flow adjusted. So what happened in the second quarter isn't reflected yet in those numbers. Those valuations will come down, especially in the VC and growth equity portion of the allocation. In addition, we have been actively deploying capital to co-investments as well as some buyout funds. So those portions will go up as capital is called. So just by that, our VC growth equity will be coming down.
I'm going to ask you to, let me just editorialize the change, build on this. You're going to see a lot of newspaper articles over the next few months about private equity, drawdowns of private equity. Occasionally, you'll see an article in the Wall Street Journal about a deal that was valued at $105 billion. Now it's valued at $64 billion. That's quite a drawdown. And what I want Craig to talk about is that as the market was roaring upward, there are a lot of funds that may have been more aggressive than we've been in terms of marking these things up as the market was roaring ahead of us. So some of our drawdowns, we may be slightly inoculated because we weren't as aggressive when things were roaring to the moon as everybody else was. So if you want to just add to that.
Yeah, you know what? Actually, can you jump to slide 4?
I'm sorry.
No, that's fine. We're going to touch on this. So basically, this is our performance. Because we have actual performance marks as of March, this is what this reflects. So the first thing I wanted to point, I'm sorry, slide 5, my apologies. This is again still June, March marks that are rolled forward into June. I'm going to go through it as the story is told. Brian's going to jump in, but then I'm going to answer your question. So I want to draw your attention to the top right. Slide 6. Slide 6. There you go. Okay. Top right box in yellow, the 15-year figure as of June 2022. We are exceeding the benchmark at 10.63%. That is sooner than expected. Remember, I've said over and over again, our earlier vintage years were hampered by two things. One, we had the overexposure to fund of funds. And two, we did that secondary that locked in weak performance from the time of the sale forward.
Because of the statutory allocation.
Correct. I would not.
What year did that happen?
Yes, that took place end of 10, beginning of 2011, 10, 11. So within 15 years. The figure, I would imagine that we would have not been above our benchmark for the 15 number for another few years. We looked at the numbers as to why that was happening. And long story short, the investments that we made from 2010 forward are performing exceptionally well versus their benchmarks, that they're overcompensating for the weaker vintage year performance. So we've been moving in the right direction since 2010 timeframe with our selection. In terms of the more recent performance.
So for 3 years and greater, private equity has been the best performing asset class. And if you look to the box where it highlights the 1 year and earlier, we've actually underperformed our benchmark. So while it's good returns relative, it's not meeting our benchmark. And a lot of that has to do with two main reasons. One, vintage diversification. Without primary commitments being consistent each year, our portfolio is older and more mature, so we're not having the appreciation of the benchmark for funds in the last 1 to 5, 6 years. Making those commitments, we would be diversified across buyout, venture, and special situations. What's happened in our portfolio, as Craig mentioned earlier, VC and growth were bumping up, and we were actually over the limit. So you've had really strong appreciation in venture, and that's come mainly at the later stage in venture. We've been investing in early stage. And you also had a dynamic where you had all these crossover funds come in Series D through Series H in expectation of IPOs. And they really weren't based on any explicit valuation metrics. So that caused those valuations to really move up above where they should have been because of dollars flowing in. Real similar to the way the public markets had lots of dollars coming in, and valuations are driven by the marginal dollar invested in public equity. So while we've done well, we're starting to underperform. We need to have more primary commitments to allow us to have the appreciation to keep up with our benchmark. And if you look at the next slide, this goes to the point we were just discussing, and this shows IPO performance relative to a SMID cap fund or index where you have earnings. So everything was focused on growth, everything was focused on future expectations, and then the market switched to valuation. And what you see is the IPO market, or those stocks that have come out more recently, have been hit really hard. Whereas those companies with actual intrinsic valuation metrics and earnings have done better. And there's a couple pieces of information. The non-profitable software companies that were public were down anywhere from 60 to 70%. The profitable software companies were only down about 20%. So the market focus changed. And those companies that come out with IPOs were usually trading on forward metrics on EV to sales versus EV to EBITDA. And so we really didn't go into later stage venture funds. We did have exposure because venture funds that are early stage have holdings that go up. They expect to realize potentially an IPO, and they even hold some after the IPO because of lockup. So we did have some exposure to that. And we did have a pullback in our VC and growth, which was a fairly high, well, was up at the max of its allocation percentage.
So to answer the treasurer's question, we actually just missed the 1 year benchmark. We beat it up until the June month. When I saw that figure, I asked ops to double check the benchmark because it just didn't seem right, but it was accurate. I think what we're seeing is, to what the treasurer had highlighted, our managers are pretty conservative. I've said that over and over again, so that when we do have realizations, whatever mark was the most recent mark, there's a nice pop. From what I've seen so far, as of, discussing the June marks with our managers, they are still being overly, I don't want to say overly conservative. They're being conservative. They'd rather underpromise and overdeliver than have the exact opposite. So marks are going to come down when we do get those June figures. Back of the envelope calculation, don't hold me to this because it's still a little early as things are rolling in. I'd say somewhere between 7.5% and 10%, but that could take, it might not be instantaneous. It might take a few months for all that to come in.
And the majority of our commitments have been to Landmark. Landmark is a secondary fund manager. They do a lot of structured transactions. Those commitments have allowed us to execute on co-investments. And so Landmark, they don't have as high returns as, say, your typical primary commitment to a buyout fund, but they have really good downside protected returns where they're able to get structural protections implemented, priority distributions, and the trade-off for those protections are a more limited upside. But we saw that as a base that insulates us in any downturns, and that helps us to execute on the co-investment.
Go ahead.
No, Treasurer, that answer your question? Go ahead.
All right. I'm looking back on page 3.
Sure.
And if I remember correctly, we used to, traditionally, we were 50% buyout and 25% special circumstances and growth and venture. Is what you're saying is that as that mix has changed, it's really changing, what our performance looks like in our measurement against those benchmarks? Because it's, it seems like you've been cannibalizing special situations allocations for buyouts.
So actually, great point. Buyout has historically been the largest part of the portfolio, but where we're seeing a lot of performance and where we allocated a lot of money was special situations. When we've done all these co-investments, that's gone to special situations. Where we've done the secondary, the Landmark, and those were big commitments, that goes in the special situations as well. So just call it the denominator effect. Buyouts going to come down. Now, we have allocated as well recently to a few buyout managers, so that would support the allocation there. However, that takes a long time for that money to be drawn versus the co-invest, and typically the secondary, it's instantaneous almost.
And that was a big part of the strategy
Yes.
2 years ago, was
That's
to
right.
take advantage of our liquidity and
Right.
special circumstances around there.
So that growth venture as well, that's been a very strong performer in the portfolio. So the numerator for that piece has grown substantially. So it became a larger piece of the pie. However, money's been coming back too. There's so many different moving pieces here: cash out, cash back, and the residual value, the money in the ground. What is it doing? And it's been increasing. And I'd say the venture growth equity had, up until recently, grown more than the other pieces of the pie.
I guess we'll also see special situations becoming buyouts, becoming.
Yeah, we try it. They're linked. Nice way to put it. The opportunities that we're seeing for co-invest are stemming from the buyout, some of the buyout commitments that we've recently made. So the
certain spaces of buyout that you like better than other spaces, or you take whatever the manager's brings to you?
So really in private equity, it comes down to manager selection. If you try and benchmark to an index, that really isn't the best way to manage a private equity portfolio.
But you may like a manager who's buyout a space somewhere, or a manager who is, manufacturing.
You find that lots of times managers who have sector specialties outperform. The whole issue is that when you have those funds, they generally aren't the size of, say, some of the larger mega buyout GPs, which are $15 to $20 billion funds.
Maybe multiple sectors in the.
They are, but I guess to get that sector focus, it's very difficult to get into them unless you've been committing to them. And if you want to do it in scale, it's very limited allocation. So we could say we want to be in media, but then those media focused general partners, we might not be able to get dollars.
We don't want to be in media.
or we don't. So the real key is that when you're talking about, if we have a focus, for us, one is using our scale to layer on co-investments so that if you have a fund and they may not be top quartile, by having them be second quartile layer on co-investment, you can then move that up. So scale also puts certain limitations on your program. So it sounds great to say, hey, we have this specific focus we want to do, but it's not as easily implemented as some people think. You have to get access to those funds, and it's difficult to do that lots of times.
So the next slide, a quick.
Did that answer your question?
Sure. Shows you kind of the industry allocation and geographic. We don't manage to any of these exposures. It's on slide 4. There you go. So the number that kind of jumped off the chart, the pie chart on the left, was the information technology, the navy blue on the left-hand side. 27.5% of our portfolio, and this is as of March, was in information technology. And it kind of was like, wow, that's a huge exposure. That's up about 5% from this time frame last year. So I did a comparison. We do this all the time to the S&P to see where the S&P was at that time. The S&P was actually slightly above, over 28%. So why did that happen? It's valuations have gone up tremendously in information technology, and we benefited from that as well. We rode the wave up.
And I think to your point, so if we just look at 4 and take Europe, let's say NCRS said, hey, we think there's really attractive opportunities in Europe. It's not like public equity where you can get out of an investment and rotate over quickly. So one, it's contingent upon who are those managers out there raising capital? Can you get access to them? And then they're going to be deploying capital over the next 2 to 4 years. You want to be investing with them so that when there is a dislocation, they have dry powder in the ground to invest. So in private equity, there's a big timeline that's needed to implement strategies. And the real key is identifying the best GPs and getting access to them.
Any questions about chart page 4? All right.
And the one thing we did avoid when you're talking about situations was later stage venture. So you had some funds raising capital, deploying it in a couple months, back raising capital again, all because they were trying to pile into later stage venture. And then we knew that crossover funds were coming in. There's a lot of capital going there. So we don't mind venture, but we definitely don't want to take the later stage risk. So that was one area that we would have avoided.
So on page 5, it kind of highlights our performance. And again, we've done this before since inception, and then divvy the time frame up into vintage years 88 through 2009, and then 2010 forward. But since inception, I wanted to point out one mark, which I thought was pretty important. There's a metric called distributed capital, DPI, on your left. It's like the third number down. That 1.07, what that means is for every dollar we've given to managers, money that was called away from us, be it for investment or fees, we've already gotten back $1.07. And we have a residual value, if you look at our total value, of approximately 0.65 times the money that had been called. So our total value to paid in, 1.72 times, where we already got $1. So for every dollar we've given out, our value is $1.72, and we already got $1.07 of that back.
We lock in the returns, but then we have to redeploy the capital.
Right. All right.
Are you saying that this 1.07 is there's 7% income in that basket of funds? Or?
So if I gave a manager $1, they gave me back $1.07, and they still owe me 65 cents.
And that 65 cents has the ability to appreciate more to higher value.
Have we seen that number before?
Yeah, I wasn't sure if everyone fully understood that, but I thought I'd call it out because it broke over that break-even mark, if you want to call it that, with actual cash back.
So it's sort of like a Costco account where you get the cash back later.
Sure. Our IRR has gone up about a quarter of a point. Last year, we were at this time 10.7%, 10.95 now since inception. And in terms of the KNS, public market equivalents, there's really no change there. Any change was pretty much a slight uptick from last year, but nothing major.
And a good way to interpret that is if you look at the bottom right, it says if you wanted to get an equivalent return in public equity, you would have had to put $1.11 in for every dollar you put into private equity, or $1.12 or $1.22.
Anything above one is a good number. Outperformance, yeah. And, you know, but this kind of really shows the differential. When you look at the IRR column, vintages prior to 2010 are in the middle at 7.65%, and the more recent 2010 to present, almost 19. PMEs for those vintage years.
Right. So which number do you look at on this chart that is just what's important to you when you're looking at these?
I look at the PMEs because I'm thinking we need to be outperforming the public markets, or why would you want to invest in private equity, right?
And what we always do is we look at the PME for the manager for their realized investments, which that has the majority of the weight on verifying performance. But then we also look at what's unrealized, the reasonableness of the marks. And then so we say, okay, you can even break it down to individual investment. You can break it down to the overall index, or you can break it down to the GICs and say, I would have invested in the public markets for energy. Would I have been better off being in this manager? And if you're over one, you say, okay, I am. I personally think you need to be around a 1.08 to a 1.20 to say you're outperforming the public markets, given the increased fees and the lockup risk. So it's a way of just looking at, does this manager really outperform the public markets, and making the risk worth it that we think is a little different than having full liquidity in public markets.
Do you have PME for each manager?
We have the ability to. When I would do that is if we were looking at a re-up or comparing them to somebody else or something like that, we would run that.
But we get hung up in acronyms a lot, just for the benefit of anybody else on it. So the PME explains exactly, the public market, what it actually means or what it is.
Public market equivalency means how much you would have to put into public markets to have an equivalent return in private. So if you're 1.2, that means, hey, for every dollar you put into private, you would have had to put $1.20 into the public markets to get an equivalent return. There's a lot of academic discussion about what is the right way to calculate PME. That's why you see all the different methodologies, but that's sort of the real practical way to think about it.
Kind of jumped around a little bit. Sorry about that. So maybe on to page 8.
Yeah.
Have you always done PME? You always presented that?
Mm-hmm.
Okay. Same question I asked.
So on slide 8, we have the private equity co-investment summary. There should be 2 corrections to this. If you look over on the right-hand side under potential total savings, that total for NCL3, which is listed as 20.1, that should really be 66.3. And then rather than 106, it should be 152. And what we're showing here is the performance and invested through March, but we actually made investment.
Tell them which block, which line, when you're saying these numbers.
Under potential total savings?
Yeah.
Under total?
Yeah, okay.
Rather than the 20.1, it should be 66.3.
Okay.
And then the total for both tranches, which is 106.1, that should be 152.
So we just caught this late yesterday.
And
Didn't sum up the two prior columns.
Yeah.
And so what we show here is for NCL3, it shows 93.3 million invested. That's the fourth column over. We made 4 subsequent investments, and we invested 163.3 million through June. And then we just did 2 more co-investments. So in NCL3, we have 231 million invested. We have the savings on the right, but the real takeaway from this is by us making primary commitments to really strong general partners, to using our scale to be significant in their funds, we're getting access to co-investment. And for the more mature investments in NCL2, you can see that right now, as of March 22nd, which is over in the middle of the page, we're at a 32.8% IRR and a 2.4 multiple invested capital, which that's outperforming our near-term performance for our primary commitments. NCL3, the GPs really don't start marking things up for a while, so they're all within October of 2021. So we haven't seen any markups on that yet, but actually the deals we've seen and we've done, we think that there's higher expected value. And you can see that in the box on the left, on the far right of that with the base case underwriting, a 2.7x and a 23% IRR. And the general partners are very conservative, so we take the conservative numbers that they're looking at. And what we've seen is there's been more upside than downside on those investments.
So did you say the co-investments are performing better than the mothership investments?
Yep. We're at 32.8% IRR on those who have matured.
And the fee structure on those is typically?
0 and 0. So that's gross and net. If that was a primary commitment, you would have had the fee and carry dilution. But the reality is we won't get co-investments without primary commitments. But that's how I mentioned earlier. You can't always get access to top quartile managers. You get access to second quartile, but by layering on co-investment, we're trying for a ratio that makes it really attractive. That's then able to elevate the performance of the general partner up into a first quartile type of return. And unlike public markets, you don't want to index private equity. There's a big differential between median and top performing fund managers.
I think we have a nice process going internally between speaking the treasurer, legal, getting NDAs done for us, and then basically the heavy lift on the legal side from Landmark, who also will underwrite opportunities alongside of us. It's been very accretive to the portfolio, and we've been able to act very fast, and the GPs appreciate that. You know, a quick no is much more beneficial than a long drawn out no thank you. Yeah.
And somewhere in that mix also is your secondary market choices.
Well, what do you mean by secondary market choices?
Do you mean like we co-invested in some secondaries? Yes, we did that. Yep.
So we're in secondaries through a primary commitment, and also another tranche. We've done one secondary co-investment that was provided by Landmark. So that's all that we have in our co-investments out of the whatever it is, the 13 that we've done. Landmark has sourced one co-investment for us that we just did real recently.
Mm-hmm.
But we have a primary fund that invests in secondaries.
Correct.
It's a relationship, and then on that relationship, you need to add.
Correct. And it's up across asset classes too. We did it with inflation sensitive, the real assets group, Ron team. So, you know, we're very sizable relationship with Landmark. We're able to do this.
And the one caveat I would make is if you think about secondaries, and traditionally you think about buying primary interest from LPs who are trying to sell them, either for portfolio rebalancing or over allocation. And so you tend to think of big discounts that you're paying. That market is pretty commoditized. Landmark does a lot of structured deals with general partners. And so I wouldn't think about Landmark as much exposure to traditional secondary sales as you might think. If you look at some other secondary managers, they're more heavily weighted to those types of transactions.
But I do remember that we were going to really focus on being the one they call. If somebody has a situation where they are out of overweight or need some liquidity, we were going to be the go-to shop. Are we continuing to do that?
Yes. I think our deal flow has improved dramatically. Really because of the couple of primaries that we have done, but also we're getting calls from groups that want to build a relationship with us too. So we're getting some looks.
But it's not so much direct. The way the secondary market is structured, it's difficult for us to go into a direct secondary. We have to do it through a fund.
It's not because Brian's the best dressed of the team.
Never had before.
He was patting himself on the back too much and broke his arm, so I have an advantage.
But it's your left arm, so you're good.
That's cute.
Yes, I'm a righty, thankfully.
I know you're trying to end, but I just want to say that but for the work that Jason's doing and the work that Ben's doing, Jeff and Christopher, our speed to market on some of these things would not be possible. So,
Yeah. And the treasurer's making himself available for us.
yeah. So,
And this is the best diligence on a fund. You get to see, it's like the Wizard of Oz. You get to see behind the curtain. And then the way we handle it makes them say, hey, we can have a real partnership with that. And as Craig said, we act really quickly. Landmark allows us to execute legals in a commercial time frame. So there's a lot of things we're doing that they see as a real benefit if they're looking for a group that's going to make a primary commitment and then go to for co-investments.
We'll go through these last few fairly quick. So this shows you our cash flow since, call it, over the life of the fund. 10 of the last 11 calendar years, distributions have exceeded contributions. 2021, it just jumps off the chart. We received back, this is on a calendar year, so calendar 21, we received back over $2 billion in distributions. Our net figure back to us, because we had about 500 million called, so 1.5 billion cash flow positive last year. Never expected that to happen halfway through the year. Remember COVID, things were starting to open up, but there was really a backlog of deals that were potentially being exited stemming from 2020 COVID, 2019, call it the trade dispute. So it really materialized last year. However, recession fears, things have really fallen off a cliff this year. Next slide, you can kind of see it. This is the market. This is not us. There are still deals getting done. On the top is new deal activity, like purchases. That is still going to be a healthy year for new deals getting done. But on the exit front, it's going to be a small fraction of last year. That's the bottom chart, 2022.
The general partners have the ability to sell at the times they think are most attractive. So in an upcycle and valuations are moving up, they take the opportunity to realize really, really attractive valuations. And they can keep working through, grow earnings, wait for valuations to move up and exit a year or two later and probably have a higher MOIC and a higher IRR.
sorry about that. That was a medical debt collector trying to track me down. Figured they could call in here.
Next slide. So we are just market trends. I already mentioned the valuations are going to be coming down more so for VC and growth equity. Buyouts, despite slowing of new deals, 2022 is still going to be a good year for buyout in terms of new transactions. Managers are also hunting in the public markets because valuations have come down so much. So it's an attractive space for them to look for opportunities. Obviously, rising interest rates. You got, managers are going to be very aware of what they're paying, not that they aren't already, but more so it's going to weigh on the total return of a target simply because the cost of debt is going to increase. So likely that they'll be utilizing less debt in the cap structure. So just from that alone, you're likely going to see some deterioration in performance, or the upside is not going to be as great as we've seen the last couple of years when debt was free.
Growth, and I was going to say where the macro doesn't support earnings growth overall as strongly, they get way more focused on their earnings to growth ratio. So even though they might be paying what we could say are still rich valuations, they're going for those companies that they have high real conviction in for growth and aren't subject to sort of macro trends for those continued, that continued growth that they have. So they get a little bit more focused and then they pay for quality.
Growth equity, those are all the names that you're reading in the paper, fallen angels, if you will, that IPO'd and went up 150% and now are off 80% from that mark. Everyone was focused on growth at all costs. Momentum plays were key. Now you're looking at fundamentals and those names deteriorated.
I guess you're also talking about special situations, or one of our general partners or a couple, they say, hey, we have mapped out all the public companies that fit our investment profile, and we know how they fit into the competitive landscape, and we also see where their valuations are. So if the public markets have a dislocation and create an opportunity, we can come in, pay a premium, but we're buying below, what we see. So you're going to see more and more take privates out of public.
The information's there, they made that call because the information's already there.
Oh yeah, public markets are fully transparent.
Yep. Next page, Kat.
So for the opportunities we have coming up, we're going to continue to look at doing co-investment. We've identified some high conviction general partners we want to come to that would have really good returns plus show co-investment. Land market is instrumental to that. We'll continue to see the transactions that they show on the secondary and structured side. And we're just going to continue building on our NCL3 co-investments.
Actually, this page 12 is exactly the same as last year. We're not changing the playbook. It's been working. It's exactly the same. Any questions?
Any questions from the phone? Greg or Michael?
Good stuff. Thank you.
Thank you, guys.
Hope you feel better.
We're going to take a short break.
Okay, we'll go ahead and get started. And we'll thank the public equity team for presenting. Thank private equity, and we'll go ahead and proceed. And I want to introduce Noah Watkins. He's number 62 on the Broughton football team this year. Been interning with us for a few weeks. So go to a Broughton football game, you can go for him. So I was glad to have you.
All right, thank you. Good morning. As you can see, the public equity team here today is represented by three individuals, Tina Kapoor, Greg Taylor, and myself. The vacant portfolio manager trader position you see on the screen, this position remains vacant for now. We want to work a little bit more on trying to identify best fit for an experienced talent who can really come into the team and hit the ground running. We're being a bit selective here, so the process is taking a little bit longer, but we're getting there. Next page. All right, on the next page, if I can draw your attention to the top left illustration, you'll see that at the end of the quarter this year, portfolio was down from our peak assets a year ago. And it's a very different story from last year when the team presented. I cautioned about the outperformance then. So here we are. But we're still slightly above the 2017 AUM, where the portfolio had a material restructure. And this is where we did the initial implementation of our internal passive strategy. So we are up a little bit from that 2017 period. The number of mandates as reflected in the top right chart shows where we now have about 17 mandates across US and non-US. Now, this is the fewest number of mandates that we've had in quite some time. And so when we're looking at this, a very concentrated portfolio like this of high quality, high conviction managers makes it all the more important for this team to really be focused and be intentional on things like portfolio management, the structure, positioning, biases, whether those biases are intended or unintended, sizing, risk, and the various things that we tend to look at a little bit more granularly on a day-to-day basis. And we'll touch upon some of those in the presentation very shortly. In the lower left chart, you'll see we're just slightly overweight. Oh, I'm sorry.
That's okay.
I'm sorry. No, go ahead.
I thought you were going to break for a second.
No.
Help me understand the phrase mandates in this application.
Mandates are our separate account strategies. So
Domestic, non-US, global, and those are separate strategies.
yeah, we have our internal investment strategies. They're separate accounts, and then we have our externally managed strategies that are managed by asset managers.
Okay.
And we tend to refer to those as mandates or strategies. The name's interchangeable, but it's just to identify that they are separate accounts that collectively roll up to represent our total equity
So it's your
portfolio.
internally managed and your externally managed. Okay.
That is correct.
Okay. Got it. Thank you. Sorry to interrupt you.
Oh, no problem. So if we go to the lower left chart, you'll see that we're just slightly overweight our domestic in terms of asset allocation as of June. And then lastly, we're over 50% of our portfolio's exposure is in passive, as you see in the lower right chart. As of yesterday, we were approximately 17 billion passively managed internally, and then the balance of that, which is roughly about 6 billion, is our international passive. We'll go to the next slide. You'll see our performance. As Jeff and Chris had indicated, this was a pretty rough quarter, as reflected in our performance, as reflected in the indices themselves. All of the major domestic indices were down, and every sector in these indices performed poorly. So while we're looking at those performance struggles during the recent period, based on that prolonged market volatility and uncertainty, our portfolio still reflects fairly strong long-term performance against the benchmark on the 5, 10, and 15-year basis, and we're net on the 3-year basis. So, we're still holding on to some pretty decent performance over the longer period.
This is still internally and externally managed.
That is correct.
Okay. Thank you.
Some of the drivers of that underperformance, as indicated earlier in Jeff and Chris's presentation, some of it was attributable to underweight to equities, but we also had some attributions to underperformance within the non-US growth. We had domestic growth struggles amidst the long duration and the growth trend reversal in the market. So we struggled against a headwind there. If we go to the next page, on this slide, you'll see where our domestic equity composite trailed the Russell 3000 on the 1 year as well in the domestic space. And as illustrated on the previous slide, we're still in line with our benchmark over the longer term basis. The domestic portfolio actually ranks in the top quartile when we compare ourselves to our public peer universe across a 5, 7, and a 10-year basis. And the modest outperformance over the 5 years has been achieved with a similar risk profile as our Russell 3000 benchmark and our MSCI US equity. IMI. So we'll touch upon this momentarily when we get to the section on risk, but I did want to point that out. And then if we turn to the next page, we'll see a.
I'm sorry.
Yeah, no problem.
The public equity, externally managed versus your internally managed, what percentage is externally managed and internally managed?
We're almost 50-50 now. We're just over.
A bit more externally managed.
Is that your target, or are you going to continue?
We're continuing to evaluate ways to expand our internally managed portfolios. I wouldn't say it's necessarily a target to be 50-50 right now. It's just looking at where can we create efficiencies in our portfolio where we can lower our costs, lower our risk profile, but still utilize active management in areas where we feel like there's better opportunity for excess returns. So in those areas that are less efficient, we want to take advantage of utilizing.
In your internally managed portfolio, it was designed to significantly reduce costs associated with the
Correct.
So how are we doing in a cost structure analysis? Are we meeting the cost targets that you were looking for? Only 50%?
We are. I mean, we manage this at an extremely low cost. I mean, we take into calculation, I think Chris usually has the CEM benchmarking study that we do on an annual basis. And by and large, the cost associated with running our internal is our Bloomberg technology and a percentage of the compensations for the team members. So.
I think a lot of the cost is fixed.
Yeah.
That Ron is referencing, the cost is fixed that Ron is talking about.
Right.
So really, I think probably as we've seen more, we've seen asset growth alone, that's helped push it down on a percentage basis on it. So I think we're right. Definitely achieving what we want in those regards.
I'm just wondering why we stopped at 50%. Why didn't we go on and do?
Well, we started this about 5 years ago, and we're trying to kind of scale gradually as we can absorb more internally and as staff can accommodate. Right now, the staff's very small, and resources are limited. So as we see and recognize opportunities to expand that, we take recommendations to the co-CIOs, to the treasurer, and say, okay, here's what we think we can do. Here's what we're going to need to do that. And here's where we see the cost efficiencies in doing so. So it is a process, but we're growing gradually.
There's a gating item. I mean, a non-US piece is much more difficult to implement, right? So that's half our assets anyways, right? So that's half our assets in public equity is in non-US, and that we've looked at doing that, the passive portfolio, doing the international assets that way, but it becomes much less cost efficient. We need different infrastructure, probably more resourcing in general.
And your risk is so much higher because.
Exactly, the risk is higher, and frankly, for the passive piece of that, we get such a competitive fee from BlackRock who manages that, that it would be, we likely wouldn't even be recognizing any cost savings. It would probably be maybe neutral, and it would create more risk, create more, infrastructure for us, more resourcing. So
that's 15 to 20% of your public equity.
No, that's close to, it's half. More than half is in non-US.
So you have reached your
I think
capacity.
And then the US side, you have the passive, which is what we're doing internally, and then the active, which we're not doing as much. We have the external managers that are managing that. We're starting to do some, which we'll talk about a little bit, the kind of enhanced kind of factor management.
Well, it was a lot of fun watching you come up with the idea of the internally managed portfolio, leveraging off what you learned in the fixed income portfolio you managed, and it's been wonderful. That's done a fantastic job.
And it's not the end. I mean, we're still researching and evaluating areas that we can improve, and Greg will touch upon a little of that later in the presentation. But we've had incredible support in ramping this up, making sure that we're doing it prudently and looking at our cost along the way, looking at the efficiencies along the way to see how we can better improve our overall portfolio posturing.
Can you change your mandate to away from the was it S&P 500 originally to now the Russell 2000?
No,
What are you marking yourself against?
we manage ourselves against a Russell.
The
A
Russell,
Russell
okay. Did you
benchmark.
start off with something else or?
No, not for the internally managed. We started off with Russell, but we started off with a Russell Top 200 and a Russell Mid Cap. So we'll get into that later in the presentation.
Okay,
but what we did was consolidate that and just have a Russell 1000 representation. The 200 and the 400 actually does represent a Russell 1000. It's just broken up so that you're able to kind of trade in either of those buckets. Now we're going to be able to just kind of trade across the entire Russell 1000. Okay. All right. On the next slide, we're going to hit the international real quick. Same thing as the domestic. The composite underperformed the index over the year. As the growth style started pulling back. This was, really what carried our portfolio, our total equity portfolio last year was some of the growth managers within that non-US. So as you see the style kind of turning, that the growth managers kind of gave back on some of that. 3 years, we still remain above the index, performance above the median of 5, 7, and 10-year basis. And the risk profile is higher than the index, but still in line with our peers on the international. So if there are no questions, we can move right along to an overview of the public equity structure and how we're positioned in terms of style, geography, and characteristics. Now, this is a fallout of just our portfolio composition, but we do track it and we do monitor, and we want to pay attention to that as we move along in our portfolio. And Tina will cover that for us.
Thanks, Rhonda. So if you're familiar with the Morningstar box, this chart is similarly formatted into 4 quadrants based on market cap and style. The vertical axis measures. Oh, sorry. The vertical axis measures size, while the horizontal axis measures exposure to value versus growth. The total equity portfolio, as well as the U.S. and non-U.S. portfolio composites, are plotted on the chart to illustrate how they compare in size and style versus their respective benchmarks. You can see that the equity portfolio's global benchmark, the MSCI AC World IMI blue dot, is plotted almost right on top of the vertical axis, indicating balanced exposure between value and growth. You'll notice it also has a modest bias towards large cap. By comparison, the total equity portfolio, which is the orange dot, is biased towards growth and is a bit larger in capitalization relative to the benchmark over the trailing 12-month period. The NC domestic equity portfolio, the blue dot towards the upper right, has a large passive allocation, so there is not much deviation from its benchmark, the Russell 3000, which is the red dot. The NC international equity portfolio, which is the gray dot, has a large cap growth bias when compared to its benchmark, the MSCI AC World ex-USA IMI benchmark, which is the green dot. Over the long-term 10-year time frame, the total equity portfolio has stayed roughly in line with the index in capitalization size, but consistently biased towards growth. This is referenced in the appendix. Next slide. For the portfolio exposures we have right now, this slide highlights the current exposures the total equity portfolio currently has. The equity portfolio is currently overweight international, growth, and higher beta stocks. This portfolio is underweight US value and high earning dividend stocks.
Okay, thanks, Tina. And are there any questions on these slides?
Thank you, Tina.
If there are none, now that Tina's shown you how our portfolio is positioned, we'll now dig just a little bit deeper into our equity return dispersions and how certain factors have actually played out within the broader domestic and international equity markets. Greg Taylor will now walk us through those findings.
So this slide just looks at US growth versus value, trailing 5-year returns. So you kind of just demonstrates kind of between 2005 up until 2020, strong performance of growth relative to value. And then in the last year and a half, you've seen that reverse somewhat with value outperforming. But even kind of with that rotation, growth is still outperforming value on the trailing 5-year period. If on the next slide, just same chart but for international markets. Similar kind of story, but you just see a more pronounced rotation to value since 2020. This one just looking at concentration in the US market. It's been a lot of talk kind of in the performance of the mega caps and kind of as they continue to outperform, they kind of become a bigger weight in those cap weighted benchmarks. So this is a measure of market concentration, and you can really see how that concentration's increased over the past few years. Did reverse somewhat in 2021, but again, it's kind of picked up again when you see the mega caps doing better relative to the rest of the market. And this just kind of gives a little bit more detail on the past year. You see the orange and white lines, which are the value and high dividend yield stocks, which are the ones that have outperformed the trailing 1 year. And worst performing stocks have been growth stocks and stocks with less stable earnings. And this has really been a reversal to what we've seen the past few years. Which you can see on the next slide, same chart, which is just over a 3-year period. You can kind of see the purple and yellow lines where those growth and high earning stocks really outperformed, and then that's come back down past year, meaning over the past 3 years, all these factors have relatively similar returns. And that kind of gets at the performance of our portfolio, which over the 1 year we've underperformed, given we've been more exposed to growth stocks. Over the 3 year, that's kind of netted out given the prior good performance, but more longer term relative performance has still been strong.
Thanks, Greg. And these are some of the things that we just kind of look at on a daily basis and try to determine, should we rebalance the portfolio? What are some of the things that we need to do to address some of the vulnerabilities or the gaps? So we would monitor that. We look it over, we come up with decisions and recommendations, and that's where we make the modest adjustments within the portfolio throughout time, because here again, very, very concentrated portfolio. So, doing too much or doing things, with, the wrong time could materially impact what we're doing. So we don't want to make rash decisions, and we constantly remind ourselves that, we're in this for the long haul. This is long-term portfolio. We're trying to look at long-term outlook. We're evaluating, those external managers to see what they're doing in terms of consistency in their approach, and making sure that they're sticking with the style. When we hire a certain manager, we're hiring them to do, a certain function in the portfolio. Deviating from that upsets our structure. Concentrated portfolio could have a material impact on that. So we just like to continue to monitor that. In addition to that, we also like to look at, what our risk return profile is. So Gina's about to walk us through an analysis of our risk relative to our return as reflected by our up and down market capture.
So with the domestic equity portfolio invested mostly passively, the expectation is that the upside and downside capture will not be meaningfully different. Over the last 5 years, the composite has captured 99% of the index declines and a little better than 100% in up markets. The NCRS domestic equity portfolio ranks better than peers in both up and down markets. Next slide. Despite the challenges over the last year, the international equity portfolio has meaningfully outperformed the non-US benchmark in up markets, capturing over 111% of the index return. The portfolio is approximately 66% actively managed. With the most recent sell-off heavily influencing results over the last 5 years, the international equity portfolio has captured greater than 100% of the index declines. NCR's international portfolio has also performed better than peers in both up and down markets. Next slide. Due to the portfolio's growth bias.
So we've got the domestic sheet showing here on slide 17, and we've got the international. Am I reading this correctly that I'm going down the domestic equity, page 17, the bottom of the first column is 100.05, 100.50. And that compares to 111.64 for the international. Is that telling me the international is outperforming by 11% the domestic equity portfolio?
No, so the 111 is how the international portfolio does versus its benchmark when the benchmark is up.
So this benchmark is different.
Yeah, its benchmark is different. So
The capture ratio, how much of it captures? So it captures 111% of the appreciation.
in our markets.
Sorry.
Oh, no problem.
Due to the portfolio's growth bias and the underperformance of growth stocks, we have underperformed the benchmark over the trailing 1-year period, negative 20.2% versus negative 16.5% for the MSCI AC World IMI Index. Next slide. Over the trailing 10-year period, the NC Total Public Equity portfolio has better risk-adjusted returns than the MSCI AC World IMI Global Index, earning an annualized return of 9.2% versus 8.7%, with lower risk than the index.
So with those last two slides, you see on that 1-year basis, we got crushed. You know, we're still in that upper left quadrant on the longer term basis, which is what we really like to see. So we're going to kind of retool, come back, lick our wounds, and hope that next year we'll be able to tell you a different story here. If there are no,
You're still here.
we're still here.
That's right. But you're still here.
Yeah. If there are no questions on these slides, we're almost done. The last section we want to present to you this morning is going to cover the internally managed portfolios. So it will address a lot of the questions, Mr. Mebane, that you've asked earlier and that Jeff and Chris had touched upon in the beginning of the presentation. You know, some reallocations made internally, and Greg will kind of go through this and give you a little bit more detail on the performance and how we're continuing to internally grow our capabilities.
Yeah, so in the past year, in February, we launched the new internal factor strategy. That was launched with 100 million in February, and then we added an additional 200 million in June. And you can see that in the table at the bottom, the internal US core.
Now, if I can interrupt here. He said we launched this new factor strategy. Greg's modest, but I mean, he's actually the one that just kind of developed that after evaluating and studying, you know, what factors have been driving, you know, our out and underperformance specifically within our overall equity portfolio, and then trying to identify, you know, how can we leverage use of our internal capabilities to kind of lessen some of those sensitivities that our portfolio has to the market, and try to manage that internally as well. So
we did that. Another of the action items which Chris and Jeff mentioned was we combined the two passive Russell 200 and the Russell Midcap into a Russell 1000. And as they mentioned, that was kind of largely to improve the efficiency around trading the two accounts separately. And we determined the best way to do that would be to add 585 million to the mid-cap names. So that brought the two accounts in line to the broader 1,000. So once we did that, we kind of combined them into one new account. And that's effective July 1st.
And it was done around the annual Russell reconstitution to lessen the ability to have any kind of frictional costs by making the incremental changes.
In your internally managed portfolio, you are tracking right alongside whatever's happening in the broader marketplace that you're benchmarking against. So you're really not doing anything except making sure that each day your balances match up to the index balances.
Yeah, in the Russell 1000 portfolio, we are focused on full replication. Yes,
There's really no decision to be made. It's just making sure you get the math right.
that is correct.
If you go back one slide here. Yeah, so this is, well, so that's for the most part true. And you can see the table gives the performance of those accounts. So the top two is those two passive accounts. You can see we obviously want to stay very tight to the benchmark, but have been able to generate a bit of outperformance, single basis point amounts, and that's kind of.
Is that called luck?
Probably a little bit of luck, but also kind of optimizing trading, reducing costs where possible, managing cash flows kind of as we bring money to the new accounts.
Managing the reconstitutions effectively.
Yeah.
Optimize what we can do about those.
We can get very low commissions on those. There's some corporate actions where we can kind of trade where we know we're going to generate some excess return versus how the benchmark's implementing it.
So it's accurate to say then in some ways we're more efficient in the index.
Yeah, in some ways we definitely can be, because they kind of have set guidelines on how they'll process certain things, and we don't necessarily have to stick to them if we know we can.
But they don't have transaction costs where we do.
Yeah.
And they just move.
Right.
So it's
not real.
Yeah, exactly.
Yeah.
I mean, for me, I look at the numbers on there, look at the excess return, anything real tight to it's a success. And adding just even a little bit on there, is a real credit to Greg, and Casey was involved in that during the process we started up as well too. So both of them, and obviously Rhonda's leadership. So to me, it's look at it and say, hey, this worked out really well. And then on the last part of the core factor, obviously you can see that was a little different. Greg touched on that, and that's really going really well too. So kudos to Rhonda and Greg and the whole team.
Yeah, so just quickly on that final strategy, that's the one where we're not trying to track the benchmark. We're looking to outperform the benchmark. And that's the new one we launched this year. And so just on the next slide, it kind of gives a bit more detail on that strategy. The areas we're looking to gain exposure. So you can see we're looking to find higher quality, cheaper stocks relative to the benchmark, and allocate to those while kind of limiting the amount of risk we're taking relative to the benchmark. And as we alluded to earlier, this is a good complement to the broader external portfolio, which is much more exposed to growth stocks. Next, this is just a high-level summary of trading activity for the year. So you can see we traded, this is internally, just over 53 million shares for a total gross value of $4.3 billion. And that's across 40,000 orders.
So this chart is internally managed.
Yep.
Only.
Yep.
And it's showing the total volume of the trades that you've instructed.
Yep.
But the trades should still be matching the Russell 1000 index, shouldn't it?
For the most part, yeah.
So you ever override that if it goes up, 0.5% to all the components? You're indexing your components to whatever the market is. How does that dictate a trade?
So a lot of it, well, parts of it will be as we get cash through dividends or acquisition proceeds.
So it's applying to the cash.
Yeah, we'll reinvest that cash into the the various stocks.
based on the asset overall allocation.
Yeah.
And will you take some out to go put it into the pension?
So we have done a few cash moves into and out of the portfolios, kind of as asset allocation changed slightly. But the day-to-day trading is more just to kind of manage the portfolios, less so to do with moving cash into and out of the accounts.
Who are the counterparties in that trade?
So we'll execute with broker dealers.
Well, there's a trade that you're describing here, the number of trades. And I know you guys are one of the counterparties. Is there a broker dealer that's actually conducted these trades for you?
Yeah, so we'll send the trades to the broker and they'll execute on our behalf.
Where do you send the trades to? Give me a couple examples.
To which brokers?
Yeah.
So Goldman Sachs, for example, we'll send them a basket of orders. Depending on the basket, we'll send that kind of different instructions for them on how to execute. And they'll go to market to work those orders, kind of give us back the fills.
For a Russell 1000 indexed portion of your portfolio, you're not sending them 1,000 transactions to update. You're just sending them one.
If it was a Russell 1000 where we're say investing cash across all 1000, we would send them the 1,000 names and they'll work those individually.
Sorry to bog down on this.
That's good.
Thank you.
So on the next slide, you can kind of see how much of that yearly trade activity occurs as part of the Russell annual reconstitution. The 154 million of those, 27 million of the 53 million shares were traded in this reconstitution. So this is the big event for the Russell indices where they're reweighting names and moving names between indices. So this is kind of one of the big weeks for us managing those accounts. And just finally looking at AUM for the internal passive accounts, you can see with the drawdown this year, AUM has come down. As of June, it was 14.5 billion, but kind of up until yesterday, I think that's up to 17.3 billion, which includes some of the cash added to the accounts as well.
Thanks, Greg. Are there any questions?
Any questions from the phone?
Okay, if there are no questions, I'll just wrap up by saying we're continuing to work on identifying ways to improve the portfolio. Our goals for the 2022, 2023 year are to rebalance the total equity portfolio, just trying to kind of align and take out some of the unintended biases where necessary, and then grow our internal capabilities as we see opportunities to do so. We'd like to thank you for the time to present today, and this concludes our presentation.
Great job.
Thank you. I just wanted to add that when Rhonda talked about the vacancy that's on their team, culture is very important to IMD, and it's especially important to each individual part of IMD, whether it's fixed income, private equity, or public equity, or real estate, or other alternatives. And there are a lot of people who are trying to come to North Carolina to live. They have to be extra cautious to make sure that they're not investing in someone who's only interested in getting here so that they can then apply for other jobs elsewhere. That's just not good for it. Our culture. It's not good for us. It's not good for our members. So that's why they're very particular, as you can see by the quality of the people who are sitting here, about who they try to attract. Secondly, Tina's the newest member of this team, but Greg and others, we did not have an internal capability in 2017. We did not have the ability to manage this stuff internally.
And so we never look at a percentage. All we look at is what brings value to our participants. That's all we look at. And Greg is a measure 4 times cut once person. I'd hate to build a clubhouse with him.
Yeah.
But it would be
It was a cut first and then try to figure out the next one.
Yeah, but it would be right if we built it. But he and the team, they look at things, and we could obviously have the percentage of internally managed money higher, but it would not be in the best interest of our members or our taxpayers. And so Greg thinks he can manage ex-US equity index funds. He can do that, I'm sure. But when you look at time zones, when you look at currencies, when you look at the tax associated with the trading of those securities,
Operational activity.
Oh, yeah.
he can't do it any cheaper than what we're currently getting it done. And that's the type of culture you want, is somebody who says, I can do this, but I don't think it's in anyone's best interest for us to do this. So that's why whether it's TOBAM or other types of things, that's why we're totally concentrated on what we can be great at. Everything we're doing right now in public equity are things that we can be great at. They're looking at other things we can be great at internally. So I'm very proud of them and appreciate you doing this. It's hard to believe it's been 5 years.
Mr. Treasurer, can I?
Yeah.
Say one more thing? Since I've been here, which is actually before the treasurer was here, there are about 6 or 7 most exciting things that we have gone through since I've been a part of this. It's things like revising the investment return assumptions. It's about approaching fraud in a different way, but also it was the bringing internal the public equities portfolio. And, I've watched it from when they first started talking about it, and they presented their ideas and they showed the economics of it. And here you are now, 6 years into it, and maybe 5 years into it. And it's meeting or exceeding everything that I thought it would do. And I'm sure that's consistent with this group. So a great job on that. Looking forward to see what happens next 5 years.
Yep. And we'd also like to thank Casey High. He's with our real estate team now, but he was actually part of that implementation as well. And, couldn't have done it without him. We had a well-oiled machine, and Greg's continuing to ensure that we maintain a well-oiled machine. That's why we're being selective about, who we bring on and how we grow the team going forward.
Oh, reducing the cost is only one part of it, but it's got to create more of your culture and integrate it into all that you're doing. Congratulations.
Yeah, thank you. I mean, we had support from our co-CIOs, and the treasurer was the first one when we presented it to him as a group. He was like, put a bow on it, and he let us run with it and watch us evolve and grow as a group. And we've had the support of the entire division. Our operations team has been phenomenal in providing us with that back office support as well. So it wasn't just a team effort, it was an IMD effort, and we want to thank everybody for that.
And let the minutes reflect that Rhonda recognized Casey. So make sure that gets in the minutes.
Reduction of fund to funds was another one of those big things that you guys have done. Noteworthy.
Thank you all very much. We're now down to our public comment section, and then we'll go to IAC members' questions and answers. We have several who are signed up. Just to remind you, we're giving you an opportunity now to sort of get yourself off mute, and we'll try to have a little gap between those. We have several who are signed up. We have a 3-minute public comment section where you can say things to the Investment Advisory Committee. We'll pause after each one to give the other one opportunity. I'll give you the batting order, the first 3 right now. And then
Ben Garner, our general counsel, will be keeping the time. So the batting order is Madeline, Judy, and Jessica. So Madeline, welcome to the IEC, and you have the floor.
Thank you. Hi, my name is Madeline Bankson. I'm here offering comment on behalf of Private Equity Stakeholder Project. PSP is a nonprofit that seeks to address the impacts of private equity and private funds managers on people and the planet. I come to you as a North Carolina resident of 20 years, currently residing in Durham County as well. Today, I'm calling on your board members to halt new investment with Landmark Partners due to Landmark's history of unfair eviction practices. North Carolina has committed more than $3 billion to Landmark Partners in the past decade, including multiple Landmark Partners real estate funds. Recently, a year-long investigation by a U.S. House of Representatives committee found that Pretium Partners, a company that Landmark has heavily invested in, engaged in abusive tactics to remove tenants from their homes, and that's a quote, abusive tactics, during the COVID-19 pandemic and corresponding eviction moratorium. Pretium owns Progress Residential and Front Yard Residential. Pretium placed tenants into the eviction filing process after they fell as little as $500 to $1,000 behind on rent. In addition, the company in some cases refused to work with tenants who may have been eligible for federal rental assistance. Instead, Pretium's policy was to only avoid evictions for tenants who had applied for assistance in the past 30 days. Many rental assistance applications took months to process due to no fault of the tenants. Pretium also declined to work with eligible tenants when their assistance payments were deemed, quote, insufficiently generous, unquote. According to Representative James C. Clyburn, quote, rather than working with cost-burdened tenants, abiding by applicable eviction moratoriums, and accepting federal rental assistance, unquote, companies like Progress, quote, expedited evictions above all else. In some instances, their abuses may have violated the law, end quote. Pretium, backed by investments from Landmark Partners, filed to evict over 6,000 households during a time of unprecedented precarity. I urge you to question the sustainability of this business model and avoid investing in Landmark and other funds that actively harm working families and retirees, including those in North Carolina. Thank you.
Thank you, Madeline. Our next presenter is Judy. Judy, you have the floor for 3 minutes.
Good morning, Treasurer and Committee. My name is Judy Coggins, and I'm a retiree of Forsyth County, North Carolina Public Schools, having taught there for 32 years. So I am invested in what the Treasurer does with our money. I have also had a part-time job with U.S. Airways, now American Airlines, over the years as well. And I had a 401k with them also, which I joined to my state 401k when I retired. So I do have some familiarity with what investments I think we should expect. The media investigations I've seen recently do not meet my expectations. Performance is worse than 93% of other public pensions. And my best analogy is that an inordinate amount of my money is being invested, like putting money in a coffee can and putting it on the shelf, or putting it in a pillowcase and hiding it under the mattress, instead of being invested at 6 times the rate of other public pensions that I've checked into. And the assumption that the next generation of educators will have to pay for the loss of $7 to $13 billion that we've missed, and they'll have higher property taxes, and many of them will have delayed retirements because of what they will have to worry about in the future. And in your WRAL interview, Mr. Falwell, I did hear the words restructure and overhaul coming up in that interview, which I checked online. A lot of educators today, I think, can see their future in me, person with a full career in the schools, but still working another job to make ends meet or to save for their retirement, but a sense that the state will be there for them to keep its promise when it comes to retire, when it comes time to retire. For that matter, I think that much the same can be said of my friends in the AFL-CIO's Alliance for Retired Americans, to which I belong, folks who may have their own money invested with the state or be married to someone who does. I have questions for you accordingly, Mr. Falwell. What do you tell young educators and their blue-collar families, folks who look just like I did a generation ago, about the failures? You explain to them why you're making them pay more and perhaps get less when they retire. What do you think this failure of the state's fiduciary responsibility to teachers will mean for our ability to recruit educators and keep them in the schools here in Forsyth County, as well as the rest of North Carolina? And simply, why are you doing this to us?
Thank you. Our next presenter is Jessica. Jessica, you have the floor. Okay. Our last presenter is Flint Benson, who's here representing Scenic. State Employees Association of North Carolina. Flint, thank you for being with us.
Thank you, Mr. Treasurer. I am Flint Benson, a lobbyist with State Employees Association of North Carolina, and I've also been a member of this system myself for over 40 years. Retired, started in the Department of Correction as a correctional officer. I retired as a warden, and now for the last 12 years, I've worked with Scenic. And I want to say that we really appreciate and want to say thank you, Mr. Treasurer, to you and your staff for cutting investment fees, just like you said when you were running for office and came in and did exactly what you said you would do. I know there's always controversy about what could have been invested better. Well, I can tell you, I'm an expert investor. If you'll give me 2 years to look and see which day will be the best day for me to buy stock, sell stocks, take money out of cash reserves, put money in cash reserves, I'm your man if you want somebody to look back 2 years to see which particular day is best. This has been a trying time with COVID. It has been a remarkable job that you've done, that your staff has done under trying circumstances like we have never had before. We've seen the Treasury system. We have seen some of it all when you've been a member of it for over 40 years like I have. I remember when we had a governor that withheld $161 million from the retirement system. I remember that well because I was one of 9 plaintiffs that took him to court to get that money back. So I just want to say thank you to you and your staff for being there for retirees, being there for state employees, and doing the job that you're doing for the state of North Carolina and its employees. Thank you, sir.
Thank you, Clint. With that, I'll deem the public comment section closed and then go around the horn for those joining us online to see if you have any closing comments or remarks.
Treasurer, good afternoon. It's Lance Brewer. I just wanted to reach out to the staff and thank them for their detailed preparation and very, very clear presentations this afternoon. Appreciate your help right now.
Thank you, Lance. Horace? Okay. Rick?
I know, sir, no additional comments other than echo thank you to the staff for your efforts.
And Mike? Thank you. I want to thank staff, the support staff that also put this together, as well as those that are in the audience today. I wanted to just say for my comments, there are no coffee cans or pillowcases of money at the Treasurer's office. Every dollar that's here is invested. Secondly, we have never increased the employee contribution to our pension plan. And thirdly, every single penny that any of our retirees are entitled to is being paid to them. Every penny, every month, every time. So I appreciate all participation at the IEC. I do want to close our meeting today in honor of Deputy Ned Bird. Some of you have heard me say that sometimes unknown is unloved. And so I don't want Ned Bird, Deputy Bird, to be one of those. This is his picture. So you know what Deputy Byrd looks like. He was one of many, unfortunately, that have been lost in the line of duty just over the last 4 weeks in North Carolina, both law enforcement, DOT workers, and others of those that teach, protect, and serve. When you get as old as I am, you've witnessed and been to a lot of funerals. I just want to encourage you, if you want to follow the admonitions of former coach Jim Valvano, who said that every day we should laugh a little, think a little, and cry a little. When you go to WRAL and watch some of the footage of Deputy Byrd's service, you will witness his K9, Sasha, who I met last week, jumping up on his casket during the service. I've seen a lot of things in my life. I've never seen anything quite like that. And just a reminder of when we talk about managing this plan for the benefit of those that teach, protect, and serve, let's keep Deputy Byrd and his family and that community in our thoughts and prayers. No smell, no taste, no song, no changing of the seasons. Nothing's ever going to be the same for that family and the broader community of Wayne County, and other places where this happened. So I just want to adjourn our meeting in honor of him and Wayne County deputy, who also was killed in the line of duty over the last couple of weeks. And just to remind all of us of a couple of things. One is that we're in the check delivery business. That's why we have the investment advisory committee that keeps us in the check delivery business. Our folks are participating in one of the strongest pension plans in the United States, if not the world. And secondly, part of that is making sure that people check their beneficiaries from time to time. If you're going to check your smoke detector twice a year, you probably should check your beneficiary once a year. I say that this is more a retirement services comment that's better for the teasers and the elders board meeting, which I'll say it also. But every time I have an opportunity to tell people to check their beneficiaries as it relates to these plans, whether it's the 401 or the pension plan, they should do so. Things change, life changes. And the reason I'm saying this so dramatically is that when something happens unexpectedly, we are stuck with the words on the paper. Just like we're stuck with the actual facts of our performance, the facts of our performance. We're stuck with those numbers that are on the paper. When it comes to beneficiary forms, we're stuck with the words that are on the paper. We can't alter them, and we don't alter them. And it's a very important message that I'm going to be partnering with the League of Municipalities, County Commissioner Association, School of Government, Sheriff Association, Police Chiefs Association, to make sure that we get this word out, that people need to check their beneficiaries when it involves these particular plans. It's very, very important. We're waiting to launch that after January 1st because we're probably in the 7th or 8th inning of getting our online beneficiary change process going. You can imagine nearly 1 million people on this plan. If 200,000 of them try to change their beneficiaries all at once, we have a backlog, and we want that to happen. So we're trying to stand up our online beneficiary change process so that if people do want to check their beneficiaries and do want to change their beneficiaries, they're able to do that online. So with that, I'll entertain a motion in honor of Deputy Ned Byrd to adjourn our IAC meeting today.
I'll be glad to do so, sir.
Thank you. Second. Motion is second being made. Any further discussion? Hearing none, the clerk will call the roll.
Mr. Brewer?
Aye.
Mr. Coakley? Treasurer Fold?
Aye. Thank you all so much, and we're hereby adjourned.